All right, thank you everyone for joining me. I have a couple of people still trickling in, it looks like. So we're going to go ahead and get started though, given that we have a short time and a really great panel today. I want to make sure that we make as much time for it as possible. We are really excited for this conversation. I'll just speak for myself. I am very excited for this conversation. We have three incredible speakers today. We're going to be focusing on inclusive investment models, which really directly relates to what Darren and Amit just spoke about in the plenary. We are delighted to be joined today by Priya Parrish, Manoj, Kumar, Nambiar, and Tracy Kartye. Priya represents Impact Engine, which is a Chicago venture and private equity firm. Manoj represents the Arohan Group, which is part of the impact investment firm Avishkar Group based in Kolkata. And Tracy represents the Annie E. Casey Foundation, which is a Baltimore-based private foundation. You'll note in their examples as we go along today that Priya, Tracy, and Manoj are thinking really deeply and creatively about how inequities show up in communities, what tools they either already have or can create to solve for those issues through their investments, and then how they can continue to push themselves and their portfolios towards greater and greater outcomes. We'll get into that in a minute, and I'll do just a little bit of setup before that. My name is Lissa Glasgow. I'm a member of the GIN's Iris Plus and Impact Measurement and Management team. And I'm really just here to set the scene and then step back and let our speakers share some really specific and practical examples of how they're practicing the new normal, the next normal in the here and now. And then my goal is to facilitate a conversation with you. So there will be a lot of asks for you to share your questions, and that's really intentional given this structure that we'll be doing today. Some quick notes on the agenda and tech before we dive in. We have a really broad global audience for the conversation today, so we'll be doing our best to jargon bust and to translate different terms as we go along. The session is open and it's on the record, so there may be journalists present and it's recorded, just to flag that to you ahead of time. We're doing something a little bit different with these breakout rooms today in that we're taking advantage of the virtual format, and you're encouraged to move between the different breakout sessions as we go along. So we have 5 of them, you have all of the links, and our goal is really just for you as participants to walk away from these breakouts with as much practical and relevant and energizing information as you can. So if as we're going along, you want to jump into another one, fully encourage that, feel free. Although I will say that based on our pre-call with these 3, it may be difficult to pull yourself away from this one. The way that we're doing the structure of the session today is that it's really intentionally set up with a lot of time for Q&A. So we're going to do a quick round with our speakers where they'll share a really specific example of how they're doing this work. But then we're not going to spend a whole lot of time with me interviewing them. We're actually going to spend a lot of time sharing your questions with them. So we should have about 50-50 sharing and then jumping into discussion, which means that you all have homework, which is to send me questions as you go along. We'll get into how to do that in just a second. And then to both our speakers, although you already know this, and the audience, to prepare you in advance, I'm going to be strict on time to make sure that we have enough time for that discussion. So if you hear me jumping in, it's just because I want to make sure that we get to discussion and get into your questions. On the technical side of things, we have a tech lead on the line, and that is Ben Ringo. And Ben, if you would introduce yourself in the chat so that folks know how to reach you. If you have any tech issues, you can reach out to him via the chat box and he'll help you with whatever is the issue. We also have a questions lead on the line, and that's Nosha Nova. We'll get into how to ask questions in just a second. As attendees of this meeting, you all are on muted, so we can't hear you speak, but you are definitely encouraged to chat. We want this to be interactive and participatory. So never fear, there's a way to chat with all the folks in the room. There's at the bottom right side of your screen, there's a chat box. One thing that can be confusing about Zoom, if you haven't spent a lot of time in this virtual environment, is how to share your chat messages with everyone. So the default, if you look at the bottom right, you'll see that there's a little to box, and it allows you to scroll between all of the different folks within the room. If you have it set on everyone, that's going to send your message to all of the other audience members, as well as all of us up on the virtual stage. We encourage you to chit chat that way, share links, share things that you're thinking about as we go along. Do not share questions that way, or questions for the panel, though. The way to share those questions is if you click on that little box. There's somebody at the top that says questions Jin. If you have a question that you would like the panel to answer, just click on that and then send a question directly to that name. That's Notion. What she's going to be doing is pulling out those questions and putting them to the side so that we can see them and we can share them with our panelists. If you share the questions to the broader group, to the everyone thing, we may not see them. So make sure that you send them to the questions box there. And again, this session is intentionally heavy on discussion time. So do send us lots and lots of questions as we go along. Final notes before we get to our speakers. We are thrilled to have these speakers on the line, and I can't emphasize enough how excited I am about this conversation. They are great examples and lots of great questions that we can ask them. This is intentionally a really diverse panel, not just in terms of gender and geography and race and ethnicity, but also in terms of the projects they'll discuss. So listen closely and we can kind of dive into some of the different differences there. Some of these will be early stage investments and others are already at scale. And the reason that these folks are up on the stage today is because they've been willing to really share openly and honestly about what they're doing that are glimmers of the future. So what exactly are they doing that is innovative and is pushing boundaries, but that we think is going to be kind of normal in 5 to 10 years. So that's the only framing that I'll give. And I've been talking a lot so far, and I know our audience has access to your full bios. So I'm not going to do a full intro. I encourage you speakers to share anything that would be helpful for folks in understanding your examples as we get in. But I'm going to ask us to jump right in. So Priya, can I ask you to kick us off and tell us a little bit about your team's investment in Hollandia Produce, and specifically, what are you doing, how are you doing it, and why is it innovative?
Thanks, Lisa, and thanks everyone for having me here. We are a venture capital and private equity investment firm in Chicago, focused on health, equity, environmental sustainability, and economic opportunity. We are impact investors focused on systems change, and we see an enormous opportunity to structurally address wealth inequality through alternative ownership structures. So imagine that you invested in a successful carbon recapture company, yet the business perpetuated the exact same inequality that we see in most private investments, including impact investments. The investors and senior executives made millions of dollars, yet most employees, which of course were mostly women and people of color, made nominal wages, didn't create any wealth, let alone even savings. Alternative ownership models essentially are structurally trying to create the stakeholder capitalist world everyone's talking about, including impact investors, yet have very little to show for. So in addition to investing in companies, we're strategic investors in funds, and we help them. One of those are Mosaic Capital Partners. It's a fund that invests in lower middle market companies to make them 100% owned by employees through what's called an employee stock ownership plan, an ESOP. And this ensures meaningful wealth creation for all full-time employees, from the CEO to the receptionist. Mosaic focuses on established private companies, typically with $3 to $15 million in EBITDA, so not startups. And they're across the US, not just the typically well-funded cities on the coast. And they invest in companies that predominantly employ blue-collar hourly wage earners and have a goal of ensuring that at least 50% of their funds dollars reach BIPOC, female, and low to moderate income individuals. So Hollandia is one of their companies in their portfolio. It's a greenhouse grower of lettuce, and 92% of their workforce are women and people of color. The majority of the 142 employees are farmers making minimum wage. And when Mosaic created the ESOP about 5 years ago to today, it has already generated an average of $30,000 worth of savings for each employee. This is cash savings that otherwise these people have limited opportunities, again, for savings or wealth creation. Another company in Mosaic's portfolio that's further along and exiting actually is creating an average of $300,000 for employees. These are amounts that these folks maybe would never have the opportunity of, period. And this is in addition to any pensions or 401ks they may have access to. So while ESOPs have been around for decades, they have not always been used with an impact objective. We invested in Mosaic because the fund is actually aligned with employees. The team has a credible background of executing on these highly structured transactions, which are not for laymen who don't know how to do this, and they're not for venture capitalists, by the way, either. And they were really interested in us, Impact Engine, working with them to modify their strategy to prioritize employee outcomes. They didn't necessarily start with that. They're what we call an impact whisperer, who's along their path. And so Impact Engine, we've helped them develop an impact management strategy. We created an impact advisory board that we sit on and have implemented a lot of the changes to their strategy that really put those employees first. So I'll leave you with just, I think, our thesis and belief that there's a universe of cash flow positive private businesses, both small and large, from a few $100,000 to billions of dollars in revenues. It's large. And with baby boomer founders looking to exit, which is honestly the thesis of a lot of private equity funds, ESOPs actually offer an alternative that creates lasting impact and a legacy for those people who do care about their employees and their communities, and tax advantages as well, because a sale to an ESOP does not pay any federal taxes upfront or annually. And there are many other alternative ownership structures, not just ESOPs, that investors and entrepreneurs should consider. And at Impact Engine, we've been really on the cutting edge of this and trying to find them and implement them. So we find funds that have the skill set to do this. We help prove that model works, so then it can be more widely adopted by other funds and mainstream private equity investors. This is what we call the multiplier effect. Please do reach out if we can help anyone begin investing with these structures, or if we can answer any questions. Thanks for having me.
Thank you. Manoj, I'm going to call on you next. And Priya, what I like about your example is that it speaks to a really core part of inclusive economies, which is looking holistically at who's involved and how we can make sure to ensure that marginalized communities are able to benefit from those economies themselves, really be able to build wealth. Manoj, in your example, you're going to take us from income generation to the way that you're thinking about kind of safeguarding that stability and that wealth. Would you share a little bit about how Arohan is working on this issue, financial inclusion in India, and why you think more managers will be taking your approach in 5 to 10 years?
Thank you. Thank you, Lisa, for having me here, and thank you for the wonderful introduction. And it's really nice to see a lot of people who tuned in to sort of hear the examples that we have. I would say, first of all, greetings from the Avishkar Group in India. We apart from the business of impact investing, which we sort of played a key role in terms of starting here in India. We also have an advisory firm which does business consulting and investment banking, and also 2 companies which essentially are in the business of lending. I take care of the business called Arohan, which is a traditional microfinance institution. And this is a company that we were able to revive from a situation where it would have probably closed in about 3 to 6 months' time had we not invested. And the example that I'm going to give you is how the Avishkar Goodwill Fund 2 essentially helped us do the first sort of formal consolidation in the microfinance sector in India. The company was really small, and it would have closed down in about 3 months' time because of a issue that we had here in a state called Andhra Pradesh. But from picking it up from there to where we are today, we are the 5th largest NBFC MFI in the country. We cater to almost 2.1 million end clients, 99% of whom are actually women. Through the 724 branches that we operate across about 16 states in India, we today employ more than 7,000 employees, and today we are the 5th largest NBFC MFI in the country. Avishkar Goodwill Fund 2, which invested in and helped us do the consolidation, is looking forward to exiting. We've already filed our papers for a potential IPO, which should happen in the next 12 months. And they would at least make at least 5 times, if not 10 times of their investment, from 2012. But the key point that I wanted to highlight here is why this business and why this particular sector. In India, with the 1.3 billion population, which which I'm sure all of you are aware of, while 42% adult Indians have borrowed in their lives, only 8% have actually borrowed from a formal financial institution, which essentially means that the rest of them who are borrowing from friends and relatives, money lenders, private finance companies at 10 to 12 times more than what a formal finance institution would actually provide. So that is really the market that I'm talking about. And today, the whole sector is about 50 billion US dollars. And at this size, we still believe it is just 1/3 penetrated. So you can understand the scope of the business. You can understand the impact which is sort of getting created, and the fact that it's a wonderful journey from helping a lady at that particular segment of society get her first credit, and then see how you can involve her in the overall financial inclusion circle by helping her open a bank account, by helping her subscribe to a pension fund, by helping her manage her investments better, by helping her get insurance cover. And suddenly you see the kind of empowerment that you've created with her in the family, which earlier was something which was which was quite different. So as a group, we apart from the money that we give, we also track the impact that we've created, and we only do investments in companies which essentially back good entrepreneurs into business models which can create huge social impact. So our investing business looks out for entrepreneurs across sectors which would help the BOP segment of society in India. Our lending companies again try to reach out to people who are unbanked so that they could get the first formal credit and make their progress towards financial inclusion. And our consulting and investment banking business also tries to help businesses which essentially want to scale up in terms of having their proof of concept. The journey from being a very, very small company to the 5th largest in the country with a portfolio outstanding of about 700 million US dollars today, as I said, covering about 2.1 million clients, essentially has been achieved through various strategic initiatives that we've done. One is about investing in technology. Second is highlighting or sort of earmarking the geographies in which you want to operate, getting a stellar management team in place, getting a whole product suite of credit products introduced, cross-sell in terms of how you can increase the touch points with your customers so that your relationship is that much more deeper apart from just providing credit, working on corporate governance in terms of ensuring that you've got a esteemed board that you can use as a sounding board for all the ideas that you have apart from focusing on corporate governance. So essentially,
Manoj,
it's really, I would say, a whole, yeah.
Sorry, I want to make sure to get Tracy the time that she needs to have. So let's circle back to that once we get into questions. Yeah. Thank you so much for that wonderful example.
Welcome.
Tracy, your example is going to take us up a level in a certain way. So Priya and Manoj both spoke about specific companies and funds that were doing this work. You're kind of thinking about how fund managers can hold themselves accountable for those impact goals, which is a theme that's woven through the other examples as well. Could you talk about the example that you're bringing today? So practically, what did this fund manager do that's different? Why? And why do you see that becoming standard in the next couple of years?
Sure. Thanks so much for the opportunity to be with you today and to share this example. As you mentioned, I'm with the Annie Casey Foundation, and I manage the foundation's impact investment portfolio. The Annie Casey Foundation is a private foundation with a mission to build brighter futures for children, families, and communities in the United States. We've allocated a portion of our endowment for impact investments with social returns that are aligned with our mission. We've been investing in strategies that support job creation in low-income communities in the US since we began impact investing about 20 years ago. Over that time, our investments have increasingly integrated a quality jobs lens. So today I wanted to highlight HCAP, a manager that has developed a successful mezzanine debt strategy while innovating around engaging portfolio companies on the quality of the jobs that they offer. The manager invests in growth-oriented lower middle market companies that are underserved by commercial banks, venture capital, and private equity. They target companies that are operating in or employing individuals who live in low and moderate income areas in the United States. Many of these companies lack resources to scale their business and have typically weak systems or controls in place, which gives the manager an opportunity to add value in the form of human capital and financial planning expertise. HCAP sources and invests in companies that value their human capital as an asset, that they're willing to commit to improving the quality of those jobs that they offer. And they believe that ultimately this is what is going to add value, increase the valuation of those portfolio companies over time as well. The manager, so HCAP will engage with the portfolio companies in their pipeline on their labor practices at the same time that they're doing their due diligence and underwriting an investment. So buy-in around improving the quality of jobs in those companies over time is there from the beginning. Ultimately, when an investment is executed, the company has, by that time, has identified and committed to a plan that will improve specific elements of their jobs over time that they believe really is key to supporting and sustaining the company's growth. This customized plan will identify specific elements along in certain areas such as broad-based participation in retirement plans, career pathways, offering a living wage or paid sick leave. And then working together with the company, HCAP will establish a baseline and develop a roadmap. They call it their gameful jobs approach, so that they can measure progress against those targets over time. And so as impact investors, we're all well aware of the need to be clear and intentional about identifying impact targets and measuring progress towards those targets over time. And I think HCAP has really excelled in this area. They've developed a proprietary data tool that integrates with the company's HR systems, so they're able to collect real-time data without unduly burdening smaller companies. The system tracks specific data points relevant to measuring the company's progress toward achieving those quality job improvements over time. And then they've also integrated the ability to comprehensively understand the workforce demographics. So they can disaggregate data and really understand what is the racial composition of the workforce by wage and by geography. It's also really critical to the manager that they integrate the worker's voice in this process and in the growth of the company. So they've integrated an employee satisfaction survey that they are able to conduct directly with employees. And another element of the fund that I've appreciated and I think is critical for impact investors is taking a continuous improvement approach. So they annually assess their lessons learned and then they adapt practices where appropriate. So I can stop there and I'm happy to answer questions as they come up.
Thank you. Such great examples, Tracy. Oh, excuse me. Morning here in Brooklyn. Such great examples and excited to dive into the questions a little bit more deeply. We are getting a lot of them coming in. So thank you to those of you who are sharing those questions that are coming up and encourage everyone else to continue sending them to the questions person in the chat box. I guess we'll just go ahead and dive right into those questions if that sounds good. Priya, there's a question coming in for you about ESOPs, and you spoke a little bit about this, but employee stock ownership programs, ESOPs, they're not new. But we haven't really seen them done at scale in the past couple of years. Could you talk about why they aren't yet broadly utilized? What are the hurdles that often come up, whether they are ones that are surmountable or ones that we're kind of figuring out how to get through them? And then is there an opportunity here for others to replicate your approach, and in what context would that be possible?
Sure, yeah. I mean, ESOPs have been around since about the 70s. They're actually a retirement plan in the US. And they have been used at scale, like even United was an ESOP at one point. I think the tricky part with them is first of all, you need a cash flow generating business. essentially the conversion to an ESOP is the result of either a debt transaction or a structured equity transaction. And you create the ESOP, you fund it with debt or structured equity, and you buy out the owners, right? So you need a ton of cash to pay back that debt. Otherwise, it doesn't work out. And that's part of where the tax benefit and exemption comes into play. That should help pay it off. But I think the reason it hasn't been as widely adopted is a couple of things related to that structure. One is that you need to know what you're doing. Okay, like these are structured transactions. Your typical PE investor, your typical debt investor, like they're not necessarily going to get it right. You have to think really thoughtfully about how much leverage can the business actually withstand? Because if you get it wrong, the employees are worse off. And so it takes, I would say, a more sophisticated investor. And that's why, like, I don't know, I've looked at a bunch and I found one that I think can really pull it off. Now, I hope other people copy. I think the second thing is that it's not always been done with this objective. When it's seller financed, there's a lot of conflicts of interest, right? The seller wants a high valuation at sale. The employees want a low valuation. And I would say that it's not always 100% ESOP. It's oftentimes, you know, the receptionist and janitor is not part of it, right? And so by actually doing it from a fund, it creates this third party that is actually more aligned with the investors. And so it's like the lack of financing, lack of knowledge, and the fact that it's been, I would say, not always, but it has been used exploitively for employees has given it kind of a bad reputation. And people they think if a company is selling to an ESOP, it means it's a bad company. Because why wouldn't you sell to traditional private equity or strategic? And so I think we're at the beginning of this inflection point where we can show this can be done well, this can generate strong returns and strong impact, but we need firms to put a stake in the ground and saying, we're doing it this way, and we're going to show you how other people follow.
And there's the follow-up question for you, which I'll send to you very quickly. Are there any examples that you can think of how this type of model has worked in Africa? The person speaking is looking at options to do it in Nigeria specifically. You can answer that quickly and or follow up via the chat.
I'm not aware of anything. We have not focused specifically on this in Africa. ESOP is a US structure and tax construct. There may be similar things there, but again, I focus on ESOPs there. There's steward-owned companies, there's co-ops, there's all sorts of other structures that are not dilutive equity with all the governance in the world that can facilitate stakeholder-owned companies. I'm just focusing on one that's most poignant. And so I think in Africa, a lot of this could be applied, but in different formats.
Yeah, maybe just picking up on that point and a couple that you made just now, Priya, the idea of really needing to know your context, where you're working, and Tracy, to your point, reaching out to folks to really hear their experiences. I wonder, Manoj, if you could speak about those points from your perspective. Financial inclusion in the example that you gave is one where you really need to structure particular products and services for the people that you're reaching. And I know there are some good examples of how you've done that with women in particular. Could you speak to that?
Yeah, so like I mentioned, financial inclusion typically, I think, gets misunderstood as only loans or credit, right? But when you look at the full requirement that a customer at the bottom of the pyramid would essentially need, that there are at least about 7 or 8 products and services which are required to ensure that she is completely financially included. Right, so credit is one of them, insurance, both life and non-life, remittances, banking products, investments, pension funds. Because all of these essentially are required to ensure that you're able to provide money when you have today, and basically when you're productive, for the old age that you need to prepare for. Right, so in our kind of business, the kind of customers that we're dealing with, at least 50% of them essentially are first-time borrowers. So to that extent, it's about the way we shortlist those clients. It's about the way we do financial literacy sessions before we even consider them for an application for credit, right? Understanding and explaining to them how you need to start taking those baby steps towards ensuring that you're able to manage the cash flows of the business, the small sort of enterprises that you have, and ensure that you only take credit which you can pay back. Why is it important to ensure that you sort of maintain a good repayment record so that your credit bureau record is good and you can actually get more loans? At the same time, how do you manage your savings? How do you open a bank account? How do you have the pride of having having a bank account in your own name? So for us, these are all really very sort of basic steps. But I think helping almost 400, 500 million Indians who would really be in that category, who would really need that formal help, is something which really keeps us going. And I think the overall sector, which today manages about 60 million clients and growing, it works towards ensuring that apart from credit, there's full financial inclusion, and also managing, also measuring the impact that we create, which is really progress out of poverty kind of indices.
Thank you. I like this idea that you're bringing up about helping people move along a journey, and I wonder if I can repurpose that idea a little bit. A lot of times when folks talk about inclusive portfolios, they're starting to think about specifically what's holding, like what are they holding within that portfolio, when actually a couple of you have spoken about how you as investors yourselves have had to kind of move along the journey and think about the way that you're approaching things and maybe shift or deepen your understanding of certain approaches. So I'm wondering, and this is a question for all of you, but maybe I'll point it to Tracy first, given your example around impact measurement and management. How have you thought about your own journey and moving along within it, but then also holding yourselves accountable? And do you think that impact measurement and management structures as they are now need to evolve to help do that?
Yes. I mean, impact measurement. So I've been at this for, I technically started working in impact investing before the Gen was formed and impact investing was a term. And so it's absolutely been a journey. And as new investors have come in and capital has flown into strategies and companies, we have to evolve along with that. Working in a private foundation, we have a lot of flexibility. We're really focused on how do we align, particularly this pool of resources, with our mission. And you can't really talk about that alignment if you don't have the data. And the challenge has always been, what are the right indicators, and then how do we get to outcomes? And so for us, that accountability is somewhat in kind of the data points that we track, and we're constantly trying to push on those and to do a better job of it. But it's also in the qualitative stories that really illustrate what the impact means and the value that the strategy may bring on the ground. But I think it's kind of a continuous process where you need to be asking those questions and then kind of trying to stay on track of how the world is evolving.
Priya and Manoj, is there anything that you'd add to that, to her point, in the way that you're thinking about it?
Yeah, so I would really say that the metrics which are being measured today really are, I would say, level 1 metrics, right? It's very important for us to get into level 2 and level 3, because where you've done the investment, at what stage you've done the investment, what is the kind of impact on the returns that you're getting from a social impact perspective, apart from being viable. All of that actually requires that our industry work towards having some common metrics, which essentially captures all of this. Right? So like you have an example on carbon credits, which is so well established that anybody in any part of the world would understand what is the sort of carbon credits that you're talking about. It is tradable, it is purchasable, you can basically sell it. So I think it's important that the industry reaches a level where it captures the key points, including the impact being created. And then it moves to a situation where it can be quantified, measured, and reported, to a situation where one could even trade on those credits. That I would really say would be the final frontier.
I would take a slightly different view. I think about measurement, like we measure to make better decisions. And I think impact investors, if they really are investing to create impact, their metrics should be used for the investee to create greater impact. It's not for them. And I think when we start to unitize and compare, let's be honest, it's more ratings than metrics. I think metrics are things that, this is almost like a qualifier for us. If our CEO doesn't want to measure this, it means it's not telling them valuable information. So it's got to be really specific to them and just kind of like unquestionable that there's value in it in a bogey. And investors just have to accept that. Like, it's not about them. It's actually about the impact.
Y'all are speaking my language on this impact measurement and management thing. I want to actually continue with this, and there's a couple of questions coming in roughly around the same general idea. So I'll throw two of them out and let folks jump in as you see fit. The first one is around, so both around accountability. The first one is around beneficiary voice, or what we would call target stakeholder voice. How do you make sure that you're really incorporating them in the conversation and possibly power sharing, possibly allowing them to make some decisions? And then also, there's a question here about what sparks the evolution of an investor to look beyond the diversity of asset managers and actually go into a deeper understanding of the labor practices of the portfolio companies. I imagine you could think about just a general deepening of approach. And maybe, Manoj, I see you nodding, so I'm going to send it over to you first.
No, I think extremely good point. So I think what is really key is, like Priya said, the whole hypothesis on which you've invested is something that is intrinsic to the entrepreneur and the business that you sort of intrinsic to the entrepreneur and the business that you sort of invested in, and after that, if the belief that particular impact will essentially help the business and the returns, right, and not otherwise, I think it'll automatically get tracked. So it's extremely important that there is buy-in and there is sort of alignment on that right from start, because if businesses are sustainable, if businesses follow the right practices in terms of labor, in terms of emissions, in terms of business practices, you are investing in something which is sustainable and long-term. Otherwise, I'm sure it's going to be a flash in the pan, which essentially would not last much. On the labor practices, well, in India, you've got a whole set of labor laws that you need to sort of follow. The government is in fact working towards simplifying that and just creating 4 labor codes, which essentially would make it easier for you to hire people, manage them, and then sort of manage the exit process without getting those hundreds and thousands of approvals that you need otherwise. So I'm sure all of that would essentially prepare us for sort of attracting more investment.
Tracy or Priya, anything to add?
I'll just say that, I mentioned in the chat, I think investors have a huge role in this. This whole entire movement, let's be honest, it's not because GPs and fund managers are benevolent and trying to change the world. Some of them are now, but it's investors spoke up and said, do this or else. And now it's time for LPs to not just say, do this or else. It's to say, do this well. Do this well. Go a step further. And so I can't like impress upon that enough, because this diversity thing and even the financial structures, let me give you an example. I mentioned Mosaic and ESOPs. I see great potential here. A lot of other folks, have maybe not been as interested because it's a bunch of white men. I'll be honest. And that's kind of, in my opinion, it's missing the point. Because if you really have a theory of change, you follow the whole thing through. And as investors in Mosaic, I'm very focused on, I'm an engaged investor on changing the makeup of their team and impressing upon them that if you're actually trying to serve these communities, you have to reflect it. Not because investors are going to tell you, but it actually, if that's your theory of change, let's do it. So if you don't invest, you ain't going to have that impact. And similarly, I can't tell you how many funds out there, I hate to say it, but they're out there talking about diversity and they themselves are diverse, and go look in their portfolio. I don't care what commitments they make. I can name to you several big funds which say it, and there is not a single founder in their portfolio that is Black. So stop saying it and start doing it. And investors need to stop asking for the label and start digging below and holding folks accountable.
Tracy, anything to add there? Otherwise, I have a follow-up question for you on a slightly different topic that's coming.
No, I just do a +1 to Priya.
So a question coming in for you. What portion of the foundation's endowment is dedicated to social investment, and what would help Casey and other funders move more of their endowment assets into mission-related investing?
Yeah, I mean, I think, so for Casey, we've allocated 4% of our endowment specifically for impact. You know, the reality is in private philanthropy, everybody's kind of approaching this question differently. At Casey, we made the intentional decision to integrate with our investment office from the beginning. So we actually manage this asset class as we manage any other asset class in the endowment. The tricky thing that makes our impact portfolio differently is that we have made the intentional decision to be very targeted and aligned with the foundation's mission. So I'm not managing to the portfolio to a market rate return hurdle. I'm managing to a return of capital, which gives me the flexibility to invest along kind of the return spectrum. And you know, not every foundation has that kind of flexibility. Some have dedicated they've kind of segregated their market rate portfolio from their PRI portfolio, which is more of a grant strategy. Kind of a unique construct to private foundations because of our tax code. But I think in terms of, you know, I think we're on a path to seeing more endowment integrating impact investing into their endowment. And I think as the field matures, as we see more products come into play that has a typical kind of risk return spectrum and adds positive social value, then it becomes more of a compelling construct, but it's still, you know, an evolution, and it's a deepening in terms of how we think about impact and how we factor that into our investment due diligence and decision making.
Thank you. Yeah, I think that speaks again to this idea of being on a journey and figuring out how to grow as folks go along. We have a lot of questions, and I realize that we don't have a whole lot of time. So I'll pose one last one to each of you, Manoj and Priya. Manoj, for you, one that's come in, what is the most innovative decision you made as part of this investment? If you had to pick one decision, and what about that do you think that other fund managers will replicate or take away?
So I think in 2012, when the opportunity came up, the typical tendency for investing was to sort of look at startup ventures, helping an entrepreneur from start to actually sort of grow the business. So I think the biggest decision here was actually to back a consolidation story, right? So I think if that particular idea had not been backed, we would not have been here today. And to that extent, the complexities which come along with that, the different cultures, the different products, the corporate structures, how would the investment happen? How would you sort of track it? How would you grow it? How would you exit out of that? All of that, especially at a time where the industry was actually going through a difficult time. So I think two things. One is the fact that you are investing at a time where everybody was holding back and not really deciding to put their money where their mouth was. Second was to back a very radical consolidation story, not knowing how it will work out. It may just flounder, it may just sort of stagnate, or you might lose your money. So I think I would really thank the investors who heard us out, where we explained to them that this is really something which is going to happen more in the future. And if we can take that leading position and make that work, both from a scale perspective as well as an impact perspective, it would actually be a big story to back. So I think those were the two, the decision to invest in a consolidation story, right? Looking at all the aspects that one needed to be covered, and then backing that up with subsequent investments for these scale and growth to happen. to where we are today, I think really was the right decision.
Thank you. Priya, there's another one here for you, and I think you have successfully galvanized a lot of folks around ESOPs based on the questions that are coming in. This question is, how have you found variations on ESOPs and co-ops where ownership in an SME may be among 1 to 3 equity partners and a community, and kind of what are the different ways that you might approach that? Is it a trust, a golden share, a protection for their voice? Could be kind of scary for investors. Are there, I guess, different ways that you've seen it approached that you think are exciting and might be something that other folks could jump in on? And B, is there anything that you would recommend for folks to read? You shared a resource earlier. I'm not sure if it's that one or if there's other ones as well.
Sure. I think it's probably a long discussion, but I think at the heart of it, there's a couple of things that are really important. One, I think investors have to think really critically about their objectives in a more nuanced way. Like no more of this, like I want market rate. Like what is market rate? And more about like risk adjusted return. What kind of risk are you taking and what makes sense for return for that? And risk includes downside risk. It includes illiquidity. It includes, I mean, there's all sorts of considerations. And then when you look at the structure, whether it's a co-op or a demand dividend or an RBF or an ESOP, is it creating that? And the next layer is there something about the structure that actually makes that more likely? And there's enough research out there, because ESOPs have been around for a long time and co-ops have been around for even longer. They're actually a core fabric of capitalism that shows that when employees are owners, they're more engaged, their performance and productivity is higher, the turnover is lower, we're able to attract better talent. And so it's kind of like investors have to, I think, get over the idea that they know better than the people who are actually running the business. They need to get over it. They have some important opinions as well and perspective from being an investor in a lot of things, but that's not necessarily the voice that makes the best decision. It's collective. And so I think philosophically, investors need to make that shift and say, if we want the best outcome, who are the voices that should be around the table? So then the specific thing around whether it's a golden share or this or that or that or that, I think it's like you almost have to like do all that pre-work and really understand the company and the nature of the industry. Is it one that's like headed towards a distress cycle because of certain cyclicality, et cetera? Or is it a growth opportunity? And is it one that has a lot of turnover or one where the employee talent is hard to get, right? What communities are they serving? And all of that together, I think will get people to that answer. But don't just start with common stock and a preferred share and whatever else. Start with everything on the table.
Thank you. I've just been notified that we should wrap up and get folks back to the room. So this is likely coming out unclear, but inclusive investment models, exactly what these three have been talking about today, are a really critical component of what we're talking about more broadly in this, this event today. I wanted to highlight just a couple of quick themes that are coming out from the conversation that I heard. And if you've heard others, please feel free to chat them as I'm speaking. One is just that investments can, even if they're trying to create positive good through the very mechanisms that they're using, actually perpetuate inequality. And so being able to look at the way that the investments are being approached and adjust for that, manage actively through the information that you're getting is important in creating an inclusive economic world. We heard a lot about the need to connect services and connect investments. So Manoj, you spoke to making an investment that was kind of an interesting choice to make, and then following through with follow-up capital to help that organization grow. Tracy, you spoke to accountability and using real-time data, making sure that you can disaggregate it appropriately, and making sure, Priya, to your point, that metrics are truly valuable to companies. So a conversation versus investors saying this is what we need, a conversation between investors and companies. And then finally, something around really having a sense of what you're doing and tracking both for the positive impact that we're aiming to create through these investments, but also understanding potential negative impacts and where those risks to impact might come in. So just to wrap up, I suppose I have nothing more planned than that, but inclusive economic growth is clearly necessary to drive towards the systemic changes that we're all going for. And I'm really excited for the next session, which is Amit speaking with Carol Ann Hilton. Some of you may have listened to the podcast with the two of them, so you already know that it's going to be a fun and a little bit spicy conversation, which is always good for these types of conversations. Carol Ann is the founder of the Indigenomics Institute and is super thoughtful about all things capitalism and changes and big ideas. So to join that session, we're going to wrap up here. You can just go back to the individual registration link in the email that you got. That is how you joined the conversation this morning. You'll use the same one to go ahead and get back into the main session now. So thank you, Priya, Tracy, and Manoj. I'm really excited to continue the conversation offline.